Imagine a monthly bill that once cost $300, soaring to over $3,300. That's now reality for thousands of condo owners across Florida. Boards blame the fallout from the Surfside condo collapse, but as an investigation by WESH 2's Justin Shear reveals, that's not the whole story. Ronnie DeMemer has lived in her Bay Area condo for 22 years, but thanks to new fee increases next year, she's preparing for higher monthly payments than she's ever faced. To have to pay like $700 or $800 a month, she says. When she first moved in, it was $150. This collapse began quietly. A retiree in Clearwater walked to her mailbox, expecting coupons and bills, only to find an envelope with her condo association's seal. Inside was a demand for $82,000. Her hands shook, but she's far from alone. Across Florida, hundreds of thousands of condo owners are opening similar letters, special assessments so massive they make their mortgages look like pocket change. The headlines call it a housing correction. It's not. It's a legislative time bomb set years ago that's finally going off. What happens when a law meant to prevent disaster ends up creating one? Brokers now say mortgage giant Fannie Mae has flagged over 1,000 condo developments as high risk for mortgages because they're underinsured or require major repairs. It all traces back to June 2021, when the world watched in horror as Champlain Towers South collapsed in Surfside, killing 98 people. It was one of the deadliest structural failures in U.S. history. In the aftermath, lawmakers moved fast. They wanted to ensure it would never happen again. Out of that urgency came Senate Bill 4D, signed by Governor Ron DeSantis in May 2022. Cameras flashed as he called it a new era of safety and accountability. The bill required milestone inspections for all condos, 3 stories or higher, and banned condo boards from waiving reserve funds for essential repairs. On paper, it looked like progress. In reality, it was a ticking bomb. For decades, condo boards had deferred costs, pushing repairs to a future no one thought would come. The new law didn't allow a phase-in, only an immediate mandate. Overnight, thousands of associations found themselves billions short. What looked like common sense on camera turned into chaos behind closed doors. The law was meant to keep walls from crumbling, but forgot about the people living inside them. 2 years later, those signatures turned into debt notices. Owners like Ronnie now face assessments that rival full mortgages. After the 2021 tragedy, laws required 3 zero-year-old condos, 3 stories or higher, to undergo full inspections and set aside new reserves. But the cost fell to owners, pushing many out of homes they'd lived in for decades. The first letters arrived quietly then, all at once. From Tampa to Fort Lauderdale, owners posted their assessment notices online. $50,000, $80,000, even $130,000 due in months. For many, it felt like a second. Mortgage dropped from the sky. In Clearwater, Linda opened her letter, $82,000 due in 6 months. Her retirement fund, $60,000. Across Winter Park Woods, monthly fees jumped to $3,371.79. The math didn't work, and neither did the system that created it, a system that keeps unraveling deeper every month. So stay with us and subscribe as the story continues. Senate Bill 4D ended that illusion overnight. The unpaid years came due all at once. Savings vanished, units flooded the market, and the shockwave had only begun because those bills were just the first hit. As the crisis deepened, lawmakers returned to Clearwater to sign House Bill 913. It gave owners access to association financial records and allowed boards to pause reserve contributions for 2 years. By mid-2024, Florida's condo market was unrecognizable. Listings once sparking bidding wars sat untouched. In Miami Beach and Punta Gorda, values dropped 40 to 50%. Officials called it a market adjustment, but agents knew better. The buildings weren't falling, the buyers were. Open houses went silent. Home resales hit their lowest March since 2009. Homeowners clung to old appraisals, cutting prices until desperation set in. Some pulled listings, waiting for a rebound that never came. Myra Valona thought she'd struck real estate gold when she bought her Fort Lauderdale condo in 2021 for $145,000. Now it's unsellable. It's not a good investment anymore, she says. Title companies report withdrawals. Lenders tightened rules, and associations scrambled to borrow or refinance. The collapse wasn't just financial, it was structural. Confidence cracked, and once that happens, it spreads. Even with the new bill letting condo boards take out loans for repairs, owners fear it's not enough. If you take out loans, you'll just pay more in the end, Ronnie says. Insurance made things worse. Premiums in coastal counties doubled or tripled, hitting $6,000 to $12,000 a year. Major carriers fled the state, forcing residents into state-backed plans with less coverage and higher risk. Rising interest rates turned refinancing into a slow bleed. Floor plan loans and special assessments collided, creating a perfect storm. Every month, the wall stood, but the math buckled. Refinancing failed, equity vanished, and once safe homes became financial traps. Retirees skipped, repairs, boards debated insolvency. Yet through it all, someone was still making money. Hedge funds, insurance brokers, and private lenders quietly profited from the fallout. When markets break, they don't disappear, they just change hands. Owners like Myra couldn't sell. She'd spent $20,000 upgrading her condo, but got no offers. We lowered the price twice, she says. Buyers were scared off by massive assessments needed for safety upgrades. While owners scrambled, inspection firms and insurance underwriters thrived. Some tripled their fees, charging tens of thousands for mandatory inspections. Every cracked beam became a new invoice. The crisis didn't just create victims, it created billion-dollar opportunities. Lobbyists pushed for stricter enforcement under the banner of safety, but records showed many had financial stakes in the firms performing the inspections. Profit disguised as protection. By 2025, Florida's condo market had split in two. Newer buildings, built after 2000, had solid reserves, clean inspections, full insurance. Older towers became financial dead zones. Banks refused to lend without current reserve studies, trapping owners in unsellable units. Values fell faster than appraisers could adjust. The law meant to restore trust had erased it. Neighbors who once shared elevators now lived in two different economies, one stable, one sinking. Owners drained savings, borrowed from family, took out second mortgages, then gave up. Foreclosures rose quietly, then sharply. The Winter Park Woods Association blamed its HOA hikes on county code violations, insurance compliance, and Senate Bill 4D. The Florida Policy Project found 1.1 million condo units statewide under the same strain. In Naples, a two-bedroom once worth $839,000 sold at auction for $480,000, a lifetime of equity gone in seconds. These weren't investors losing bets, they were residents losing homes. The collapse spread beyond condo walls. Small community banks that financed associations showed strain. Delinquencies climbed. Developers froze. Projects and insurers faced collapse. Construction cranes stopped mid-air, silent over half-finished sites. Economists whispered the same words. It feels like 2007. Only this time, the cracks started in the foundations themselves. By late 2025, even buyers had vanished. Shane Costa's HOA jumped from $634 to $2,100. His one-bedroom drew a $70,000 investor, offer one of many scooping up desperate sellers. There are people who just couldn't take it anymore, he said. They had to sell out. Former Senator Jeff Brandes warned, developers will come in and redevelop these properties. And they are. But something unexpected followed a revolt of information. Condo owners started posting invoices, inspection memos, and reserve studies online. Every hidden flaw, every overcharge exposed. What was once whispered in HOA meetings now spread across TikTok and Reddit. Transparency moved, faster than marketing. Realtors could no longer hide half-truths. Forums replaced open houses. Spreadsheets replaced brochures. Power shifted quietly from agents to the people. Sellers, who once set the price, now faced questions they couldn't answer. And that's when this stopped being just a Florida story. Because when information spreads this fast, no market stays local. What happens when buyers know more than brokers? This isn't just a crash, it's a reckoning. A new lawsuit now claims some associations are working with investors to terminate condo ownership and convert them into apartments. One example, the Stone Creek at Wakiva Association, accused of ties to a real estate firm in Boca Raton. The board denies it. But the pattern is clear. Ownership is being stripped from the very people who built these communities. This story began with a single letter and ends with a night need. Warning: a law meant to save lives instead upended them. The assessments, auctions, and bankruptcies are proof that safety on paper means nothing without foresight in practice. You've seen the law, the fallout, and the silence that let it grow. The question now isn't who to blame, but what we'll learn before the next letter arrives. Because if transparency can reshape how we buy cars, book hotels, or rate cities, maybe it can rewrite housing too. What shocks you most about this story? Drop your thoughts in the comments.